Yo, VGT's higher returns look tempting, but IWF's better risk-adjusted performance means you're getting smoother gains with less heart attack potential. Now let's shift gears and look at VGT. Crushed it with 21 percentage points. More return over 5 years. That gap compounds into real wealth over time. But here's where it gets interesting. VGT's 141% 3-year return is the kind of growth that makes investors sit up and pay serious attention to tech. Let's zoom in on this. IWF's 124% 3-year return looks solid until you realize VGT beat it. Strong gains, but still second place here. In plain English, here's the race car truth. VGT finished 17 percentage points ahead over 3 years. Both ran the same track, but one car just had more horsepower under the hood. Here's where the story takes a turn. VGT's returning 23% this year and staying ahead, and that's the kind of momentum you want when tech's leading the charge. Let's break this down further. IWF's trailing by 4 points at 19%. Consistent underperformance that's becoming a reliable pattern you can't ignore here. VGT's winning every race here, but those extra returns, they're tied to extra risk you'll need to stomach. In plain English, think of risk-adjusted returns like an amplifier knob. Anyone can crank the volume by taking more risk, but you want louder music without blowing out the speakers. Higher scores mean better efficiency. Let's dig into the details. VGT's 1.2 Sharpe ratio means you're getting solid returns without taking excessive risk. That's exactly what smart investors look for. Here's where things get revealing. IWF's 1.3 Sharpe ratio means you're getting better returns per unit of risk, smarter investing, even with lower total gains. Now let's put this in perspective. Here's the twist. IWF is actually more efficient with risk, while VGT just took bigger bets to get those higher returns. In plain English, think of the Sharpe ratio as your investment report card. VGT worked hard for returns, but IWF is the straight-A student here, squeezing more profit from every bit of risk it took on. Here's the thing though, VGT's Sortino ratio of 1.7 shows solid performance when we focus purely on downside risk, filtering out upside volatility noise. Let's take a closer look. IWF's 1.8 Sortino ratio proves it's better at protecting your downside, winning on risk-adjusted performance over 3 years. But here's where it gets interesting. IWF's better downside protection means you're getting solid returns without the stomach-churning drops. Small edge, but it adds up over time. In plain English, the Sortino ratio is smarter than regular volatility metrics. It's like tightrope walking where only the falls matter, not the wobbles. IWF delivers fewer dangerous drops per point of return you earn. Let's see how this plays out. VGT delivers higher returns but struggles with risk efficiency. Now, let's see how these funds handle the real stress test. Market crashes. Here's what really matters. VGT's worst 5-year drop was brutal, down 35%. Your 100 grand would have shrunk to just $65,000. Now, let's connect the dots. IWF's worst crash was 33%, just 2 points better protection than its competitor. Not exactly a massive safety cushion here. In plain English, maximum drawdown is your worst roller coaster drop. How far your investment falls from peak to valley. IWF's drop was 2% less terrifying than the alternative, and those cushion points really matter when you're plummeting. Let's unpack this a bit. All right, who's taking the crown here? Drop your vote, VGT or IWF. Here's the key takeaway. That's over 13 months watching your money just sit there, waiting to break even. Not exactly investor paradise here. Now let's flip the script. IWF's slower recovery reveals weak momentum, taking 453 days despite a smaller drop. Shows you're waiting longer for your money back. But there's a catch. VGT's got serious resilience. It drops harder but bounces back faster, showing you'll recover quicker when markets rebound after crashes. In plain English, think of recovery like a marathon runner after a stumble. VGT face-planted harder but bounced back fast. IWF barely tripped but stayed sore much longer. Different injuries, different recoveries. Now, let's put this in perspective. VGT's worst year crashed 43%. That's the kind of loss that makes investors panic and abandon their strategy entirely. But here's where it gets interesting. IWF's worst drop was 38%, offering 5 percentage points more cushion than competitors when markets crashed hardest. Let's zoom in on this. IWF shines when markets collapse. That 5% advantage translates to thousands of dollars staying in your pocket during the worst crashes. In plain English, when the market storm hit, both funds took a beating. But IWF's shelter held up better, proving that in brutal downturns, even a little extra protection matters. Here's where the story takes a turn. VGT's 25% volatility means you're getting bigger price swings than most ETFs. Expect sharper ups and downs daily. Let's break this down further. IWF's 22% volatility means 3 points less turbulence than VGT. Calmer rides for investors who want growth without the wild swings. Here's where things get revealing. IWF's lower volatility means fewer wild swings. Perfect if you're the type who checks your portfolio daily and values peace of mind. In plain English, VGT is the wild roller coaster with extreme highs and lows, while IWF is more of a gentle ride. Both will get your heart racing, just at different speeds depending on your thrill tolerance. Let's dig into the details. VGT's 1.4 beta means it amplifies everything. 40% more movement than the S&P, both up and down. Here's where things get revealing. IWF's beta of 1.2 means you're signing up for 20% more volatility than the broader market here. Now let's put this in perspective. VGT's higher beta means it amplifies market moves. Bigger wins when times are good, steeper drops when they're not. But wait, there's more to the story. Here's the battle so far. VGT's crushing it on pure returns across every time frame, but IWF's playing defense better, with superior risk-adjusted metrics and lower downside volatility. In plain English, beta's your amplifier knob for market moves. VGT cranks it to 1.4 times. When markets swing, you're feeling every bump amplified. IWF's gentler at 1.2 times, but still louder than the market itself. Let's take a closer look. $9 a year on 10,000 invested. VGT's 0.09% expense ratio is about as cheap as ETFs get. Now here's where it gets tricky. IWF's expense ratio doubles the competition at 0.18%. That's $18 yearly on 10 grand, which adds up significantly over time. But that's not the whole picture. VGT's 9 basis point cost advantage over IWF compounds beautifully over decades. That's real money staying in your pocket instead of fees. In plain English, think of expense ratios like couch change. VGT lets you keep more coins in your pocket every single year. Over decades, those tiny fees compound into real money you're either keeping or losing. Here's what really matters. VGT's 98% tech allocation means you're getting pure, undiluted exposure. No diversification safety net, just straight technology stocks. Now let's connect the dots. IWF's balanced approach means you're not betting everything on tech. Half your money's diversified across other sectors for stability. But hold on a second. VGT's concentrated tech bet means wilder swings, bigger wins when tech soars, but steeper drops when it doesn't. IWF smooths the ride. In plain English, here's the pizza analogy in action. VGT's heavily concentrated in tech, almost all in, while IWF splits its bets 50-50 between tech and everything else. Same sector, totally different strategies. Here's the key takeaway. IWF's nearly half non-tech allocation acts as a cushion when technology stocks crash, keeping your portfolio more stable overall. A VGT's packed with 98% tech. When that sector tanks, you're sinking with it. Diversification? Basically non-existent here. But there's a catch. IWF spreads risk across sectors for smoother rides, while VGT's tech focus delivers massive gains but brutal crashes when things turn south. In plain English, IWF spreads its bets across sectors with half in non-tech, while VGT goes all in on technology. It's the classic egg basket dilemma. Diversification versus concentration, each with its own risk profile. Now let's shift gears and look at VGT's betting 11% on smaller tech companies. That's your ticket to explosive growth, but expect rougher rides along the way. But here's where it gets interesting. IWF keeps it safe with just 1.4% in small caps. This fund's betting on big, stable names, not risky startups. Let's zoom in on this. VGT's betting on small caps for extra juice, but that means wilder swings. IWF plays it safer with mostly large caps. In plain English, VGT's got more rocket fuel with its small cap tech exposure, while IWF plays it safer with established giants. Think more explosive growth potential, but buckle up for bumpier rides when markets get choppy. Here's where the story takes a turn. VGT's best year delivered a massive 62% surge. When tech rallies hard, this fund absolutely crushes the competition. Let's break this down further. IWF's best year hit 43%. Solid gains, sure, but it still trailed VGT by 19 percentage points. Let's dig into the details. That 19-point advantage shows you what concentrated tech exposure delivers when market conditions turn favorable for VGT's focused holdings. In plain English, think of it like fireworks on the 4th of July. VGT is the grand finale that shoots sky high, while IWF is a sparkler that's nice, but doesn't quite steal the show. Let's dig into the details. VGT's tech focus means you're betting everything on one sector, thrilling when it wins, devastating when it doesn't. In plain English, VGT's like loading one side of a seesaw. You'll get wild swings. IWF spreads weight evenly for a smoother ride. Same playground, totally different experiences depending on your risk appetite. Now let's put this in perspective. VGT's winning the battle here. Better returns across all time frames, half the fees, and pure tech exposure when it matters most. But wait, there's more to the story. IWF's winning on 3 fronts here. Better risk-adjusted returns, lower volatility with downside protection, and genuine sector diversification when crashes hit. Here's the thing, though. VGT's for thrill seekers willing to ride 43% crashes, while IWF offers growth with smoother sailing and better cushion during downturns. Let's take a closer look. VGT's for the aggressive tech warriors with patience, while IWF is your safer bet if you're balancing growth with smart risk control. In plain English, think of VGT and IWF as dance partners. VGT pairs with risk takers, craving wild moves, while IWF suits balanced dancers wanting excitement without wiping out. Choose your partner based on your investing style. But that's not the whole picture. This covers everyone legally. Do your own research before investing, always. Let's see how this plays out. That's a wrap on our ETF battle. Hit subscribe if you want more weekly comparisons that cut through the noise.